Hopefully you've had a great day and been quite informative in terms of what you've learnt. We've got the three of the most active investors in the Australian market. What I wanted to do was briefly introduce each of the parties on the panel so you got a better feel for their background and what they've done in the last probably 2 years in terms of investments. And then I'll ask some questions of the panelists and then we'll open it up to the audience in terms of any questions you may have. Okay, so briefly about myself, as Leo said, I used to work at PwC as a partner there, saw the opportunity to become an entrepreneur, to see how easy it is to become an entrepreneur in the Australian market. And I was completely wrong. It's the hardest thing I've ever done. I should go back and work at PwC. It was much easier. Through that journey, I set up Hunter Bay Capital to help startups to growth companies and mature companies in terms of raising capital, help them with business plans, as well as doing mergers and acquisition for the bigger companies. So that's my background. Adam?
Hi there. So personal background is I was from the UK. I started out doing investment banking for some of the larger technology companies in Europe before moving to do some more operational stuff at a image recognition and augmented reality company in Europe as well. And then so I joined Airtree about 18 months ago. Over the last 18 months, been involved with investments like Bright, who do solar financing, Happy or Not, who do kind of consumer terminals for MPS, and also Thematic, which is an NLP company coming out of New Zealand. So Airtree invests across every single sector from really early stage, 200K all the way up to 20 million. Looking to invest in really kind of world-class founders building category-leading teams. So pretty sector agnostic, but a traditional kind of VC model.
Luke?
Yeah, hi everyone. So I'm a managing partner at Artesian. Like Adam, I started investment banking, but I think with the grey hair I stayed there a little bit longer. It's about 20 years across ANZ and UBS. My last role was at UBS in New York, where I looked after TMT, trading. So my background's largely been fixed income and full capital arbitrage and distressed assets, which I guess fits quite nicely into VC at times. I guess our firm is a little bit different to others on the street because we're actually an alternative asset manager, a global alternative asset manager with a specialisation in fixed income and VC. We've got offices all over the world, Sydney, Melbourne, Shanghai, Singapore, London, New York. We're a full stack VC. We invest from seed stage all the way through to later stage. We have 10 funds at the moment across Australia and China, about 250 mil under management. We have 200 portfolio companies spread across just about every vertical business model and geography imaginable, which makes my life interesting at times. We invest in between 30 and 50, or we make between 30 and 50 investments a quarter, with ticket sizes ranging from 50K at the seed stage right through to 5 million plus for some of the later stage or the later funding rounds of our portfolio companies. In addition to high net worths and family offices, we're funded by some of the biggest institutional LPs in the country, like Host Plus, Future Super, Australian Ethical, also industry bodies like the CEFC. We source our deal flow by partnering with accelerators, incubators, angel groups and universities. Some of our key partners, Sydney Angels, Blue Chili, Slingshot, University of Wollongong, SproutX, The Actuator, Energy Lab. I know I'm going to forget one, so hopefully no one's here that I've forgotten. And in China, to name a few, Brink, Xeroth, and SOSV. So we have the same model that we operate here in Australia and China. I guess we're agnostic tech in that we'll invest in, at a seed stage anyway, tech that we see high growth potential with relatively low capital lifecycle requirement. But we've developed, and continue to develop verticals, but we've developed verticals across ag tech, clean energy and med tech to align with our Pan-Asia strategy to address food security, reducing carbon emission, energy efficiency, waste reduction and health and wellbeing. So that's us.
Okay, thanks Luke. Damian?
Hi, so I'm Damian Fox. My background's also to be different from investment banking. Started off in Sydney, and then after that moved across to New York. In New York, I was sort of sitting halfway between a sort of private equity role and a M&A sort of role. Off the back of that, was looking in going and setting my own business up in the States at the time, and just fortuitously there was an opportunity to come back to Australia and be a part of setting up a VC fund here. So we did that in late 2013, early 2014. Carthona Capital's now got about 250 million of funds under management. Raised our latest fund towards the end of last year, about 100 mil. Our investment style is highly thematic, so we'll spend a lot of time as a team going, okay, cool, what's a theme that really excites us? We'll independently go away and do a lot of research, come to a table and think about, okay, cool, this is what's happening in this space, and given the check sizes that we like to write, okay, this is the most exciting vertical for us. And so what that means is we're highly high conviction investors. In terms of check size, like to write sort of in the early stage, and when we say early stage, we like to sort of go pre-seed, seed, Series A as our initial entry point. In that stage, anywhere from sort of, 1 to 2 mil initially, and then with the intention to write sort of 2 to 3 thereafter. In terms of sectors, pretty agnostic. We've got a global mandate, so we can invest anywhere in the world. Our portfolio is probably predominantly in Australia. Then next biggest area would be in the States, and then we did our first investment in Europe late last year. In terms of notable companies, in Australia, most known for Zero Latency is a successful virtual reality business based in Melbourne that's also got centres all throughout Asia and also through the States. Credible, we listed on the ASX last year. In the States, probably most known for Peerspace. Google Ventures just recently led their Series B, and a business called Ouster, which is a LiDAR-based business.
Thanks, Damian. So look, what I want to do is start from an investor's perspective, share with you guys what they're looking for and what are the things that they've seen, so that you get a feel for the type of characteristics in startups that they're looking for. So in that regard, Adam, I guess you've all mentioned you're sector agnostic. And from what you've said, if I'm a startup, I go, you know what? I can approach it because I think I've got the best business in the world and, you should invest in me. There must be some characteristics or certain things you're looking for in startups that attract you in terms of making that investment. Can you share with us what they are?
Yeah, for sure. So I'd say, take everything that we say with a bit of pinch of salt, because, we're all VCs, which is a certain type of funding. We're all, by the nature of kind of venture capital, looking for very outsized returns. So, we're looking at it with a specific lens. I'd say that, we also have different LPs in terms of the mandates that we have and the sorts of companies that we look at. And this is the same across, all types of investors. They have a specific mandate that's set out by their LPs that says, we're going to invest in X, Y, and Z. So I think it's good to kind of research when you're talking to investors what their kind of mandate is and what they like to invest in. So we're all going to kind of have different opinions, and every investor will. In terms of what we look for, I think we're fundamentally looking for product-centric teams building category-leading businesses. We've got this really big bias towards fantastic products that users really love. Like, that's kind of the real core of it. Is if you can build a product that users are telling everyone about and kind of knocking down your door to come and buy from you, that's the best thing that we could see. So there are a couple of examples of that. We've got one company, Different, we invested in last year. They try and automate the real estate agent piece when you're a second homeowner or if you're renting a home. So Mina, who's one of the co-founders, she used to be head of product over in Uber. She's incredibly product driven. So she's been spending the last, I don't know, every single weekend since we invested about 7-8 months ago, doing the job of a real estate agent to understand exactly the pain point that they go through. Like, she is living this day in, day out. She's letting people in the door. She's doing absolutely everything to truly understand the product that is going to make every person's step in that kind of chain a lot easier. So it's kind of this obsession with product that we really, really like. Something else that we really like is kind of domain expertise. We think that where can we find specific advantages for companies? It's like, okay, well, if the founders have 10, 20 years specific expertise in this one area, they're going to be in a much better place than other people. So one of other companies, for example, is thematic. So Aliona spent basically 10 years in the NLP research space before building out her product there, which relies very, very heavily on NLP. So, we kind of look for product focus and domain expertise for, category leading businesses.
Okay. What about yourself, Luke?
So we're, I guess we're a little bit different as well. We don't invest outside network. So, and when we do, it's only if a startup's completed what we would consider to be an approved accelerator or incubation program. And I guess we just start with that because it helps us scale out, our DD and information analysis. It doesn't necessarily produce winners, but I think it helps at that very early stage anyway get rid of uninvestable companies, which and they might be uninvestable for a number of reasons, and it's not to say that they won't come back at some stage, but at that stage they're probably just not ready for money. I think the other thing from our perspective is that whilst our model will capture moonshots and unicorns or whatever you want to call them, we've designed it also with the Australian M&A market in mind, which is really a market sub 100 mil. And in fact, I think most of the density, especially around corporate acquisition, is probably somewhere between 30 and 60. Right, John? I mean, you probably know a bit more than me. So for us, we want to invest as early as possible because it gives us a lot of flexibility around our portfolio and allows us to turn the investments substantially faster and also exit with a substantially better return than you do when you're working at a later stage. So again, for us, it's at that very early stage, so long as you have that high growth potential and relatively low capital life cycle requirement, we're really interested. And because we're only investing a small amount of money, we treat it like an options portfolio, so we can actually spread ourselves quite wide, and we use our accelerator partners to help us, filter that deal flow so that we'd probably estimate in any 5-year period about 10,000 companies are going to be started. We thought the best way to try and capture, and it's only a part of it, and it means that it doesn't mean that we don't we'll capture everything, but we're hoping to capture the top 20% of the market, and then we hope to capture other companies that don't need to go through that acceleration process through our angel group, Sydney Angels. So we see a lot of founders that either don't need to go through an accelerator, that they've got their funding in place, they've had successful exits, they just want to go there for the network and for the ability to attach to the fund. Other than that, what Adam said, I think is fairly similar across most of the VC space. When we're looking at the later stage investments, we're looking for that domain expertise, strong product, big market, ability to scale. You're looking for really strong growth metrics across the business that can help you, come up with that point. You're looking at a strong team. And I guess you're also looking at companies where you think you can make a difference as well, where you can help them, where we can use our resources to actually help get them to the next level. We're also we're a co-investor as well. We like to invest with other firms. I think we've done numerous deals with both these firms. I think for us, we like that validation, and we like the optionality that gives the founders and the businesses moving forward as well. So we always like to see co-investors in our deals.
Right, thanks, Luke. Damian?
Yeah, so I'd agree with everything that's just been said. If I look back across our portfolio, without trying, if I look, one constant theme that I seem to see is businesses that have really high IP, or businesses that you can build a moat in. So that, as a VC investor, the worst thing we can do is invest in a business which, we're not going to see money back for, 10, 15 years, who knows how far down the track, is a business that you build up to a massive scale, and then a competitor can come in and just sort of encroach on your territory very, very easily. So I guess that's one theme. In terms of, like any investor, at the beginning, the most important thing is the entrepreneur, and the entrepreneur-investor relationship is sort of a subset of that. There's no point, as an entrepreneur, you need to prove to your investors that you are globally the best person to go tackle this massive problem ahead of you. And similarly, you have to be able to work with your investors. At an early stage, your investors are going to be way more hands-on than they are way later stage in your business. And so as a result, at both the good times and at the bad, you want to make sure you have a good working relationship, and you don't end up in this toxic board circumstance where you've got diverging interests, and you want people to have this common goal of succeeding, of the business succeeding. Secondly, the TAM. So lots of people talk about operating in a big market. I think people get caught up with, this is the market size, as opposed to, really thinking through what TAM, your total addressable market, means. So if, for the type of business that I'm doing, the type of services, what actually is addressable, and what do we think is, what percentage of that market do you think we can realistically get? Thirdly, certain businesses are just not open or are not perfect for VC investment. And so, there's some things that you like to see as a VC investor, and that's scalability, unit economics that make sense, sort of evidence of product market fit, that sort of thing. And then finally, the deal has to make sense. So if you've got an entrepreneur or a business's expectations around pricing up here and the investor's expectations are down here, well, you're never going to make that work. And similarly, if you've got a circumstance where an entrepreneur might have taken some early friends and family capital from less price-sensitive investors at a certain rate, sometimes that means that actually, when a more price-sensitive professional investor comes along and they're valuing the business down here, you might end up in a circumstance where the business just can't take that additional capital because they've, effectively they're going to have to crunch those friends and families who have supported them at the beginning of the life cycle of the business. So, that can just stop the deal.
All right, thanks, Damian. As I said earlier, I left PwC and started a great new startup, which I'm sure you've all heard of, called Roadrunner Mobile Tyres. So it's a tyre business where we come and replace car tyres at home, and it's a B2C model. And one thing I've learned over 5 years, B2C is really hard in terms of getting traction and getting scale. Now, we've got a lot of B2B and SaaS members here. Is B2B and SaaS a more attractive sector for you guys to invest in versus a B2C model? Luke?
I mean, it has its own challenges. I think the biggest challenge that we see with our B2B startups is the coming to grips with the enterprise sales cycle. And it doesn't matter how good the product is and how much work you've done around it. Really getting and cracking that enterprise sales cycle is difficult, and it's not so much that you don't crack it. It's just understanding the time that it can take to get through a big organisation to adapt, the product and just the bureaucracy and stuff you got to go through. But even once they sign it up, I also find the next challenge can be adoption within the firm. Like how do you? It's all well and good to actually get the enterprise to sign up, then you've actually got everyone to adapt it, and that can be out of your hands because it's how the firm actually dictates to you how you can do it. So, and it's kind of, I guess, a trial by error situation for a lot of the funds, and if you run out of money while you're doing that, it can get quite dire. So, we've started to see some really interesting solutions to that, but I think that's the biggest challenge, and it's almost as hard. I mean, I think that the B2C is really a funding issue. It's just having enough money to do it, whereas B2B, you've really got to solve that cycle.
Yeah. What are your thoughts, Dan?
Yeah, so our portfolio is probably 50-50 B2B versus B2C. Having said that, though, comment I'd make is all B2C businesses have a B2B element to it, whether that makes them a B2B2C or whether there's just generally a partnership nature to it. And one of the businesses I mentioned earlier, Peerspace, it's a quintessential consumer-facing marketplace. But having said that, though, if you look at how the growth has come, it's come from partnerships with big companies. And for example, they've got a partnership with Uber. A lot of Uber's sort of out-of-office activities have been pushed through this platform. That's driven strong growth in the marketplace, which has been driven by a business relationship, despite the fact that it's theoretically a B2C business. With I definitely agree with the comments around sales life cycle, sales times, and sales lead times. If you're giving a business 18 months runway and their lead time is 2 years, especially at the very, very early stage before they've had a chance to really build up a really, really strong pipe of enterprise sales, well, if the business runs out of capital before they can secure that contract, well, what happens? The business pretty much stagnates, and then you get to a point where do you reinvest? The founders aren't happy because it's at a flat valuation, and the investors want to see an uplift as well. So that's some of the challenges, but the good thing about VC is that you're investing in hard problems, and so if you can overcome that, it means that your moat, your ability to protect your share of the market is so much stronger than you would be in a traditional B2C space.
Adam, anything to add?
Yeah, I don't think there are for us there aren't any major differences. B2C and B2B is fine. I think at the end of the day, it all comes down to product. You're still selling to somebody. It's just whether they're sitting in a business or sitting in their own home. It's just a different way of selling to them. We've had successes in B2C like Canva, Pet Circle, who do online pet shopping, and more recently investments such as Spaceship, which is kind of one of their new superannuation plays. And then on the B2B side, we've had companies like Prosper do well, Employment Hero, who do kind of SME HR stack. So there are successes everywhere. I think just as long as you're building a product that people want, everything else kind of comes together. It's just about structuring your business and your sales around which model you're going after.
Yeah. Okay. We might just change the tack and now focus from an entrepreneur's perspective and giving advice to them. One of the things I see quite common with entrepreneurs is they go, here's my business plan, here's how big the market is, I'm going to take 1% of the market, therefore my business is worth $100 million. And that 1% of the market is not an easily achievable target, even though it sounds easy when you say 1% or 0.1% of a market. What advice can you give entrepreneurs around how do you set expectation in terms of the growth rates and what's realistic that's get presented to you that you can believe in, rather than just simply say I'm going to take X% of the market share that I play in? Let's start with Damian.
Yeah, sure. So I don't really, although from a market sizing point of view, it's useful to do a percentage of a market. That's interesting. I don't think predicting how fast your company is going to grow has got any connection with. It's a connection, but at the early stage, actually predicting growth and going, I'm going to be at 0.1% of the market at this point, and 0.2% of the market is really the right approach. Look, to be honest, it's a business by business case. If you sell widgets and you sell your widgets for $100 and you've got confidence you can send 10,000 widgets, well, that's your number, and you should be I would think about it more like that rather than a percentage of the market. But certainly from when you're looking at the value of a potential opportunity, if you can with confidence say that, over time, and maybe it takes 10 years, maybe it takes 15 years, maybe it takes a lifetime, I feel that if I can get my product good enough, I can take 10% of this market. Well, that gives you a good feel for how big this thing really, really can be.
What about Adam, your thoughts?
I'll just make one comment on some founders doing market sizes. It's just really helpful to be specific. Sometimes we'll get companies, like take SpaceX for example, they didn't do this, but imagine if they came along and said, hey, we're playing in the 2.3 trillion superannuation market. You'd be like, yeah, but that's not really your market. Your market is specifically, a demographic within there who have a certain amount in their superannuation. So just being like far more granular about the actual target market you're going after, rather than just being like, I'm going to go get the 1% of the Chinese market and it's huge. It's like, yeah, but like, what are you actually doing within that market?
What about yourself, Luke?
I guess not a different view, but I think it just comes down. However you do it, market size or whatever else, it's. As a founder, you've got to come up with the balance that convinces investors that this is a blue sky opportunity, but you've got to have a financial model behind it to back it up. So it's a bit of an art, I think, where you want to have a base case which people can understand and you can kind of justify, but you need to also build the blue sky around it. So I think it's just building that or finding that balance to get attract investors, but also not put them off when they sort of start doing the numbers and start making sure that the business plan actually fits with the financial model.
Okay, so from an entrepreneur's perspective and the ones that you've actually invested in, are there any common elements or process they've gone through that makes it more likely to be successful in terms of getting investment from you guys? So Adam, what are the things you've seen from successful entrepreneurs that you guys have invested in? I'd
say, go out and meet investors early. It's never too early to start conversations. Go and have a relationship. As Damian was saying, this is kind of a marriage. It's actually harder to get rid of an investor than it is a co-founder. So you are truly in the trenches with probably the key person, but also the larger organization. So you really want to check them out, and you should be doing DD both ways. So kind of trying to develop that relationship over a period of time, I think, is really, really useful. Like it's, if you're sitting on our side and a company comes along and you meet them for like 45 minutes and they say, hey, can I have $2 million? And you're like, I don't even know you. Maybe. Like that's, whereas somebody comes along and is like, hey, we've been chatting for like 6 months. You've kind of guided me as to what you think I need to look like for you guys to be interesting. And you kind of have that kind of working relationship, then it's a lot easier to have that conversation. So I'd say kind of start those conversations early, even if you're a long way off from fundraising, and hopefully it'll give you a bit of guidance as to what you should be aiming for. So yeah, I'd say that's a big one.
Luke?
So the question was what?
So with all the successful investments that you've seen, What are the common traits or processes they've gone through? That
I think obviously business traction. I think investors having a good group of investors through a number of rounds, and I think just what I said before, like just getting the blue sky right with the rest of the model and where you're at, so that people actually buy into where you're going, and you can actually demonstrate a business, and you can demonstrate traction, you can demonstrate that the model that you've got in place works, and if X, Y, Z happens, we can get up to here, and I think that's can be very attractive to investors.
Okay, Damien?
Yeah, I think the core theme is the skills of the entrepreneur. So whether that's technically or whether that's just ability to sell, and that's whether selling a business or selling a business to investors. Those, if I look at our really successful businesses, each of those, both the leading entrepreneur and the technical entrepreneurs are at a point that every time you speak to them, you're wowed, and you think you come up with some DD questions. You're like, oh yeah, I'm going to hit them at this next meeting, and I'm going to find out, and they answer them like that, and they are just off onto the next level. And so, that's obviously hard to just go and make us. It's not really an answer. It doesn't really help you go, okay, cool, I'm going to make myself better. But I think it's just becoming a real expert in your field and improving your ability to entice investors and to be a salesman, even if you are a CEO.
I'd add to that it's a lot of it's practice. It's just like a lot. I mean, the skills that you need is kind of this storytelling ability to get people on board, but a huge amount of it is practice. And as you go through kind of investment meetings and stuff, you'll start to pick it up. So it's just go out and do that a ton of times, practice on whoever you can, practice wherever, and just hone in on those skills. And then I genuinely believe that pretty much everyone can hone in those skills. There are just some people who actually go out and make sure they're better at it than others.
I was just going to add that I think good founders with good businesses always get funded.
Okay. What I might do now is just open up to the audience in terms of any questions you guys may have to the panellists. Anyone got any questions? Do we need a mic?
G'day. Quick one, first mover advantage, comments? How important is it? How detrimental not to have it, etc.?
Damien, do you want to?
Yeah, look, there's obviously an advantage. There's always an advantage in the land grab. But having said that, though, I think if you look at over time, most areas of technology businesses, the better product wins out over time. And I guess I'm just reiterating what Adam said earlier, that hey, if you've got a good product, people will buy it, and if you're solving a real customer pain point, that's more important than necessarily being first out of the gates.
So there's a good example, recent example of this is actually HipChat and Slack. I don't know if you follow that story, where HipChat, Atlassian bought HipChat, which is very similar to Slack, many years before Slack kind of came out the gates, and they probably didn't invest in HipChat as much as they should have done, and Slack came from behind, and because it was a superior product that had better kind of growth built into it, it massively took market share over HipChat, and the announcement the other week was that HipChat has now been shut down. It is no more. So it's important, but product usually wins out.
We've got a question here. Oh, there you go.
What are your top three sort of turn-offs when looking for a company to invest?
One each.
Yeah, okay, one each.
Someone who reeks of being full of it. You speak to them straight away, and I love a salesman when I say this, but someone who you question them, and they tell you this, and you go, does that seem right? And then you try a little bit more, and then you finally get to a topic that you actually know a whole lot about, and you ask it, and you realize, they're saying this, but actually,
Really high unsustainable burn rates.
I say just not knowing your shit. Like if I'm in a meeting and I'm like, what's your cash burn? And they go, I don't know. You're like, what do you mean you don't know? Like the lifeblood of your company is cash, and you don't know how much you're burning, like last month? Like, how are you running this business? So just like making sure across those numbers and just across how you build your business.
Question there.
Just a quick question, Damien. You mentioned previously that at least your company, it has sort of themes that you tend to focus on. I'm just wondering, maybe just quickly across, are there any particular themes for each of you that you're particularly excited about right now?
So one thing I'd say is that how we decide, that sort of thing is we regard as our IP, But one area that I'm highly disappointed that we haven't made an investment in, I was just talking to Adam about this, is ag tech. I think there's a real opportunity in Australia to really dominate the world in that space. And unfortunately, our portfolio, we don't have a single ag tech investor. So if there's anyone out there that has got a great ag tech business, I'd love to hear about it.
Luke, do you want to
I was just going to say that our vertical specialisations, for the reasons that I stated at the start, ag tech, clean energy, and med tech, we're addressing food security, carbon emission reduction, energy efficiency, waste reduction, and health and wellbeing.
I guess for me personally, it's probably I look specifically into kind of fintech, energy, IoT, and then I've started to do a bit of digging around space and quantum just in my spare time because I think it sounds cool and I want to see what's going on. So we've done a fair bit of research into those two sectors, keeping our eyes out.
Any other questions? There's one here.
I've got the microphone, I'm
Where is
sorry. Luke, just touching on what you said, you basically finished off saying if the company's really good, it's going to get funded. Not so long ago, I heard a really successful entrepreneur from the Silicon Valley also say that. So I asked a few people in VC what they thought about that because I thought that was an interesting comment for him to make. And one of the people I spoke to said, that's not true. And they are an investor heavily in the Sydney space, and they said it's a lot actually to do with luck, timing, being early to markets, what's already out there, this kind of stuff. So whether you're right or wrong, cool. Would love to hear some more thoughts on that, maybe to do with the Australian ecosystem.
I mean, there's a lot to be said for being in the right place at the right time, no doubt. I think, I guess I'd address it like this. I mean, we work in an industry that has relatively low barriers to entry. And if you think about the success rates, they're relatively low compared to the failure rate. So the noise that you hear around failure is usually overwhelming, and it's a big voice. So I guess that's the voice that a lot of people tend to hear and tend to extrapolate.
Comment I'd make would be that sometimes this is more of a Silicon Valley phenomena, but sometimes you get into this circumstance where these big funds have raised billions of dollars, and so they're chasing these big massive outcomes. And so I've seen businesses before that are great businesses that are maybe worth $50-100 million and actually just can't get capital just because they're going to be worth only $800 million because actually the fund is looking for a $2 billion opportunity that can return the fund, and then they can just sort of coast for the rest of the life cycle of the fund. So definitely there are circumstances out there, but I would reiterate that if you're in a hot area that's got this massive market size and you're a really good entrepreneur, I would hope that you get funded. And fortunately, there's a bit more venture capital available in Australia now. So please come pitch us if you've got that great idea.
I also pick up on the comment you said, wrong time or wrong place. Or I'd say, even if you have in theory, a good business, if you're in the wrong time, then that's unfortunately a bad business. That's not going to go anywhere. I'd probably generally agree with that comment, but it might take a lot of no's, right? It is a numbers game. There is some element of luck, but if you've gone and talked to 100 people and got 100 no's, then it probably isn't a great business. But I think some people they expect a yes after maybe like 10 conversations, but even good businesses will still have to have sometimes 50 plus conversations with investors just to get one yes.
Any other questions?
Kind of flipping this on its head a little bit, say there are businesses that you were quite interested in investing. Why would you ever make the argument you shouldn't take investment from you guys? To what reason? Like, what reasons would you have to argue against your own existence? Basically.
I would not.
I think it comes down to like what type of business a founder wants to build and what kind of ambition they have. If a founder wants to 100% own their company and build a nice business that might be worth 10 million one day, it's pretty great, right? I'd take 100% of a $10 million business if you just gave that to me. That'd be awesome. But other people just have far greater ambitions. They want to build $1 billion business. So I think the mindsets have to match up. So sometimes I meet a ton of great companies that VC just isn't suited for. So in those situations, I say, look, I don't think you should be talking to VCs. I think you should be finding different ways to fund your business, because it's a great business, but it's not appropriate for what we look for.
Questions?
For all three, how many pre-revenue companies have you invested in?
Over 20 for us.
Probably about 180, 190, I don't know, something like that.
I'd probably say out of, I think our portfolio is 41. I'd say probably, I think it's 8 or 9.
I would add that it's probably how we see our specialties. We like to go pre-revenue, and that's why when I say pre-seed, seed, sometimes Series A is pre-revenue these days. So.
Yeah, so we source all our deal flow. So we have 5 seed stage funds, which basically take pre-seed investments. So, and you have to go through the accelerator. So often, we're dealing with a couple of founders with just an idea. We do it a lot, and that's how we build our model around that.
It's positive to hear because most VCs in this country say they're pre-seed, but then they expect revenues of $1 million plus before they even talk to you. So it's really great that you guys are doing that.
I think that's why we've got the right VCs here, right, for startups. Any other questions?
Do you have any views on companies that are wanting to be designed to be multinational versus prove your worth in Australia before you try to stretch yourself too thin?
So look, the only comment I'd make is that it's a thing that everyone's heard before is Australia's a good proving ground. I think it depends on the type of business. I think it's actually quite hard to take businesses offshore. You have to have a very specific type of probably consumer-facing business. Most B2B type businesses, there's always a different sales channel. There's always it is actually quite complicated to go offshore, even to seemingly similar markets. So. I would much rather invest in an Australian-only business that has a massive TAM here than I would one that, look, I can prove it out here and then maybe I can go offshore and roll the dice again and see if I can get some traction there.
I mean, yeah, horses for courses, but I mean, depending on what your fund's mandate is, I think you're always looking for businesses, if you're investing in Australia, that can expand globally and scale globally. So, you like to get as many of those as you possibly can, but it doesn't preclude, you from actually investing in companies that are going to be successful in Australia. And I think I explained before with our model, because we invest so early, we have a bit more optionality around that, because we don't have to get as bigger exits out of our investments because of the IRRs that we can get. But
I think we look at both. We've invested in companies that even their first customers were US customers, and they did global from day one, versus others. I think in the investments that we've made in companies that are kind of doing the journey where they prove it out here, our investment has to stack up. If they were just going to do Australia, like, you can't be investing on the basis that maybe they'll go out afterwards. So I think that's kind of just difference now, I think.
Okay, the only thing I'd add, sorry, we've got a big China fund, and I think it's entirely different there, because you're just looking at it to scale in China. But anyway.
All right, I might just have one more question from the floor.
Hey guys, just a question from the panel here. Historically, there have been a number of policy measures from government to try and stimulate VC activity in Australia, VC partnerships and directly through tax incentive grants for the companies themselves. What sort of things does the government do well to try and stimulate this? What sort of things do you think we should do in terms of trying to help out stimulate this in Australia?
Luke, do you want to take that one? About ESVC, LPs?
ESVC, LPs are great. Just broadly speaking, I think you want a government that supports an ecosystem without getting too involved. I think we're kind of in a situation in Australia where there are some great initiatives around that. I think sometimes where you see some of the grant process that's going on, you can get a bit distortive, albeit that I think it can be useful. So I think you just want a government situation where they're supporting an ecosystem such that founders can actually get out there and create businesses and be connected with funding from VCs and other sources.
I think our R&D incentive scheme is absolutely amazing. So whoever came up with that one is a genius.
And yeah, R&D tax is fantastic. They're also looking at reducing that, so that's not ideal. So I think also just one thing to mention is the whole visa issue in Australia is just terrible for tech talent. I mean, the fact that if you look at any kind of standard jobs in technology, like a PM or a UX designer, they're just not in the visa categories, which is ridiculous. So, at a time when Trump and the US is shutting down all of these phenomenally talented people within the tech world, surely it's the time when Australia should be more open to that. So I think visas in Australia, especially come from the UK, and how hard it was for me to even get a visa, and it's so difficult for some of our portfolio companies to get really good talent. I think it's pretty shocking right now.
So there is one visa, which is the 188E, which is you've got to be an entrepreneur, and you can if you've raised more than, I think it's $200,000, you can apply for this visa. The unfortunate side is that it's I think like an 18+ month process, so you have to have a visa first, be here, and then you sort of roll onto this bridging visa, and that's very hard to invest into a business which the founder may not be able to work in at some point in the time in the future.
I think there's only been one of those, and that was actually Roman from one of our companies.
Is that right?
Yeah, he's the only one who's done this, so that's how difficult it is to get this entrepreneur's visa.
All right, one last question from me. Apart from money that you guys provide, what additional things can entrepreneurs expect from you once the money's been invested? So, Damian?
Yeah, so because we, for our initial investment, like to go so early, we're highly, highly hands-on. So, as a minimum, we'd be speaking to our entrepreneurs, especially in the early stage, once a week. With some of them, it's more like daily. There'd be certain few entrepreneurs, especially at the moment, that if I went through my missed calls while I've been at this conference, it will just be entrepreneurs that you're working with. For us, the reason we do that is just at the beginning, it can be a lonely job being an entrepreneur, and having someone to sort of a sounding board that you can say, oh look, I'm thinking about doing this, and just sort of think through the logic, is really helpful. Similarly, when things aren't going that bad, it's really good to be across it, and not finding about it at the next board meeting, but instead finding out about it in real time, and being able to sort of lend a helping hand and make sure if there's a way to solve the problem, or at least get ahead of it, that we can be there and assist.
Luke?
Our companies that come through, our early stage funnel through the seed stage funnel with accelerators, get follow-on funding. Guaranteed follow-on funding, provided they do certain things, which I think is solves a really big issue for founders out there. Secondly, our global network and all of our firm's resources moving forward.
And Adam?
So the way we like to think about it is that, we want to be that first call, not only when things are going really well, but also, if a founder's going to ring up and be like, I think I may have fucked up. Like, we wanna be on the other side, and for the founder to be that comfortable. I think that's really earned through trust. So it's about working with the founder. It's about communicating regularly, whether that's once a day, once a week, however kind of our founders want to do it. We also do a whole ton of what we like to call platform, which is we've got about 40 portfolio companies, from companies that are looking to IPO all the way down to pre-revenue. So we've got a ton of experience in matching our portfolio companies up with those that are a little bit further on or having the same kind of issues. We also run a ton of kind of breakfast sessions. So we've done them with Anil Sabharwal, who's the VP of Google Photos, runs Google over here, with our portfolio, with mainly our sort of key portfolio people who are doing product. We had Hugh Williams, who is VP of Engineering at Tinder and eBay, come and do a CTO session. So we're constantly looking at plugging in these world-class people into our portfolio companies for sessions or for help, or wherever we can. And we also have Andrew, who's our in-house recruiter, who does a ton of recruitment for all our portfolio companies. Because, on one side, it's great for the portfolio companies, but very selfishly, if we can place the best people into our portfolio companies, then surely they should be better companies. So it's kind of a win-win on that side.
All right, so our time's up. As I said, you've got the three most active investors here. Hopefully you guys will get a chance to approach them and do a quick pitch and get their cards and get to know them. But their insightful message, it's basically they're straight shooters. You're not going to get sugar-coated message from these guys. They're not going to waste your time. They're going to give you quite honest and frank feedback. And as I said, it may not be the first pitch that where they invest. It might take you 3 or 4 or 5. It could take a year before you've got your business to a state where they can invest. You just got to persevere. And I've gone through the same journey raising capital for my startup, and it will happen as long as it ticks all the boxes. So, can you all join me in thanking Luke, Damian, and Adam? Thanks, guys.